But first, Coinbase CEO Brian Armstrong, well, he is the latest Bitcoin bull to break out the good old vision board. On the Cheeky Pint podcast, Armstrong said he sees Bitcoin reaching $1 million by 2030. Let's take a look at the clip.
What is your prediction for the 10-year rate of growth, like average annual growth in the Bitcoin price?
The rough idea I have in my head is like we'll see $1 million Bitcoin by 2030, and there's high error bars around these things. But just to give you a couple of data points, right? It's like we're starting to see regulatory clarity emerge in the United States, which I think is a bellwether for the rest of the G20. You have the Genius Act passed now for stablecoins, but this market structure bill is being debated in the Senate. Fingers crossed, something could happen by the end of this year. That would be a huge milestone. The United States government now has a strategic Bitcoin reserve. So that is, if you'd asked me 5 years ago, that would have been kind of like vision board. Someone would have said, you're crazy. Like the United States government's not going to officially hold Bitcoin. But if they do that, which there's now an executive order to do, I think a bunch of other countries are going to do that.
Well, you heard it from the man himself, $1 million per coin by 2030. Because apparently if you run a crypto exchange long enough, you start making predictions like a fortune teller at Coachella. Now, Armstrong is not alone. Eric Trump, the blonde one, says it's no question Bitcoin will hit $1 million. Eric even calls himself a Bitcoin maxi now, which is hilarious because if you told me 10 years ago that one of the Trump kids would be a Bitcoin diehard, I'd have guessed it'd be Barron. But not everyone is strapping on rocket boots just yet. A researcher from the University of Pennsylvania says, let's try to hold 124K first, guys, which is fair considering Bitcoin spiked to 124K and then face planted back down to 112. Meanwhile, Galaxy Digital's Mike Novogratz warned that cheering for $1 million Bitcoin next year isn't bullish, it's apocalyptic. His point, if Bitcoin hits $1 million in 2026, the U.S. economy is basically Mad Max and you'll be using your Lambo as a tent. So exciting times ahead. All right, we're bringing Joe back to the show. Joe, when you hear Brian Armstrong calling for $1 million per Bitcoin by 2030, do you see that as genuine conviction or just Coinbase's version of a motivational poster?
Coinbase's version of a motivational poster. I mean, ultimately, Coinbase's game is to drive users to their platform. The way that any non-Bitcoin only crypto company, as it were, works is particularly Coinbase and the likes of FTX and Binance and others is listing as many tokens as they possibly can to farm fees. That's their business model. So ultimately, it makes a great deal of sense for him to be calling for things like $1 million Bitcoin. It drives people to his platform so they can farm fees. A more measured take would be this. And I totally agree with Mike Novogratz. I've said this so many times in the past that you don't want Bitcoin to be $1 million within the next 12 months or within the next 5 years even, because that means something terrible would have had to happen in the world economy. And probably the price of Bitcoin is the last thing you'd be worried about. Bitcoin ultimately, it acts as this apex asset, this apex hedge against perpetual monetary debasement. We live in this credit-based global economic order where money is lent into existence. And so Bitcoin acts as the best hedge against that. It acts as the best sponge for global money supply and global liquidity. It tracks credit cycles very closely. And so ultimately, if Bitcoin were to be $1 million within a year, 2 years, 5 years, something horrible would have had to happen with the global financial system. So I'll say that. But the more measured take and the take that I think people should be optimistic about is that if you look at prior cycles, the way that Bitcoin used to behave compared to the way it behaves now, boom and bust cycles are getting far less volatile, right? They're not a thing of the past, right? But they certainly are less volatile than they once were. One data point that should be really encouraging to viewers is that last cycle, Bitcoin spent only 39 days above $60,000. That was basically the key psychological level. It hit that, 64K and 69K all-time high twice that year. So far, since Bitcoin first broke above 100K, it spent 131 days above that level. And it's now spent 45, 46 days above 110K. You can see the price behind me. And so ultimately, this consolidation we're experiencing is extremely healthy relative to prior cycles. And so, other folks, Matt Siegel, who I'm friends with, has spoken about 180K by year end. I think that's a totally reasonable target. Right now, the reason Bitcoin, is kind of channeling where it is not just because of its own native factors, but also because right now the Jackson Hole Symposium is happening in Wyoming. And usually every single year when this happens, equities kind of trade around doing not much of anything. The U.S. economy is pretty robust and resilient. We're going to be expecting the Fed's first maintenance rate cut of 25 basis points next month. So really the path of least resistance for other risk assets is higher in the near term. And people can probably expect this kind of stair-step price action of consolidation, then moving up to a brand new all-time high, and then consolidation through the end of the year until the macro regime changes.
Yeah, we're at this really interesting inflection point, I feel like, in Bitcoin's journey from being initially considered as a risk-on asset and now starting to kind of fulfill that promise as a true store of value as digital gold, right? But with that, you have these big price predictions, which were great and fun, right? But the fact that people are saying $1 million, I don't think that's indicative of where we are with Bitcoin right now. Slow and steady truly wins the race. And if we want to treat Bitcoin and want the world to treat Bitcoin as a reserve currency or as a store of value, slow and steady is the way to go. And I think you're very on point with, we're not seeing those crazy shifts that we had in previous cycles. It seems to be a lot more just watch a number go up, but slowly and steadily. And I think that's a real credit to the maturation we're seeing of Bitcoin as an asset class right now. So fun times, maybe not as fun if we're looking for those parabolic rallies, but I think we can safely say, you and I can, Bitcoin is definitely here to stay despite some of those detractors out there. At an institutional level, do you feel like these $1 million price predictions are helpful in pulling new allocators to the Bitcoin space, or do serious investors just kind of roll their eyes at this kind of stuff until Bitcoin proves itself step by step, kind of what we just talked about here?
Yeah, for sure. So I think there are two different cohorts when we talk about institutional allocators. The first being obviously the folks who are buying these spot Bitcoin ETFs in size, those being pension funds, endowments, and others. And those are, types of allocators who plan on buying and holding it for a very long time rather than selling it. Pensions in particular, right? They're not the buy something and then sell it immediately type allocator. They buy something, hold it for a very long time, and then gradually wear down that position. And with endowments, they just hold on to these things for decades at a time. You look at places like Harvard and Brown, they're perfect examples. Harvard bought $117 million worth of IBIT, that's BlackRock spot Bitcoin ETF, in Q2. And so ultimately, that is cohort number one. We're talking about institutional allocators. And I think the main thing that drives them to this asset is two things. Number one, it's price performance relative to other assets. Actually, on our website on joinhorizon.com, we've shown basically over any 3-year period over the last 12 years, Bitcoin is the best performing major macro asset. You compare it to the S&P 500, to real estate investment trusts, to U.S. Treasury bonds. That's anything 10 years and up on the U.S. Treasury yield curve. Trounced all of those things. And so, that's factor number one. And then factor number two is ultimately an asset that hedges against the current macro regime, which I spoke about briefly. But basically, we're entering into a period of fiscal dominance. We haven't seen one since World War II. And essentially what that means is that keeping rates at a low level to keep the debt manageable is more important than any other thing that monetary policy sets out to accomplish. So monetary policy obviously has a dual mandate with the Fed. Stable prices and full employment, right? And by stable prices, it's a bit of a misnomer. What they actually mean is making sure that CPI goes up by 2% every single year on an annual basis. So that's its dual mandate. But now, given the fact that our debt load is so high, $37.2 trillion with a debt ceiling that was just raised to $41 trillion by 2031, and the more pressing concern is the interest on that debt. The interest on that debt is now approaching $1 trillion. It's on track to surpass $1 trillion and approach $1.1 trillion annually by the end of this year. And so the primary concern now is keeping rates low. And so that's why, even though the U.S. economy is rebounding, we are going to be cutting, and the market is betting on 100 basis points or 1% worth of cuts over the next year between now and next July. So that's essentially the era we're in. The Fed is now not just acting on that stable prices and full employment mandate which it is clearly achieved. I mean, CPI has basically hovered around 2.7% for several months on end. It's now more concerned at the behest of the U.S. Treasury to make sure the interest expense on our national debt is manageable. And so that's a great environment for risk assets. It was a phenomenal environment for gold post-World War II. And it's a phenomenal environment today for Bitcoin, which is an asset that performs gold's chief function better than gold itself. So that's essentially the era we're living in. Despite a pretty robust economy, despite price inflation coming down to manageable levels, the Fed is cutting anyway. And basically the only reason they're doing that is because of the interest expense. This is only going to accelerate as our funding needs continue to remain exactly where they are as a country. Cutting spending hasn't worked out very well for us. And Jerome Powell is set to be out in May of next year. And Trump is undoubtedly going to pick someone who is working for the Treasury, working for what Trump's aims are to do, and that is to be making sure the U.S. government stays solvent, the Fed doesn't have to print money to buy the excess debt. And so chances are he's going to pick someone, he's going to nominate someone who is even more dovish than Powell. He's going to make sure that whoever gets in there keeps rates as low as they can so that our debt levels are manageable.
And I know there's been some talk, we've had this tariffs, and we have record tariff money coming in now thanks to Donald Trump just throwing tariffs at everybody he can find. And there's been talk of people saying, well, why don't we use some of that tariff money, because it's technically budget neutral, you won't have to charge the taxpayers, to buy Bitcoin to potentially help solve some of that debt problem. I mean, number go up, right? Do you think that's a feasible solution? Or do you think that's just people talking because right now we're finally getting some government regulations in the space?
Yeah, I mean, it's partly a solution. There are a couple of things that come to my mind. I mean, year to date, we've had about, I think, $117 billion, if I'm not mistaken. The Financial Times just put the figure out. Scott Bessent, U.S. Treasury Secretary, just said it a few days ago or yesterday. And currently we're running a $2.2 trillion annual deficit, so more money that we're spending than we're actually taking in. So if we allocate 100% of the tariff revenue to paying off the deficit, then it tackles about 5% of it. And the year-end projection, because not all of these tariffs have gone into effect, is about $300 billion. But again, that figure, our annual deficit, is $2.2 trillion. So if we allocated 100% of it, you'd be looking at 15% of the deficit being managed and being taken out by this tariff revenue. The thing is, the asterisk here is that not all of the tariff revenue is going to be going to paying down the deficit, which is a really silly thing. If that was our sole aim, then it's what we would be squarely focused on. And despite what economists may be suggesting, that's not what the U.S. Treasury is squarely focused on, which is kind of insane in my mind. But it makes sense from another point of view. If you consider GDP, the sole barometer by which the Federal Reserve and the U.S. government gauges our nation's economic well-being and our economic productivity, government spending is a massive component of GDP. It's about 40%, 35 to 40% of that GDP metric. And GDP, by the Fed's accounting, needs to be rising by 2% to 3% quarter over quarter. That's what they want. And so if suddenly the government stopped spending more money than it had, and it stopped spending this, fresh money into the economy, that would be a very bad thing. And so, all of these cost-cutting measures and all of this talk about reducing the deficit are running directly up against one of the primary ways in which GDP stays at that level, which is a core function of the Federal Reserve, making sure that we don't have 2 consecutive quarters of negative GDP growth, because that constitutes a recession. And so if the Fed's main game is to make sure that we don't have any kind of prolonged recession, but on the other side of it, the U.S. Treasury is talking about cutting spending and reducing the deficit, these two things are not lining up with each other whatsoever. And so ultimately, there are 2 different situations in which we get out of this scenario. Number one is that we cut spending and induce a multi-year, potentially multi-decade recession, right? Totally eliminate the deficit, and in doing so, all of its contributions to GDP, right? A recession can happen. A multi-year recession can happen. The Fed has made sure of it. It let the music stop in 2008. It's never going to let that happen again.